All right. Well, I think folks are going to keep coming in. It looks like that number just keeps climbing up. Um, but we'll go ahead and jump in and get started. Clearly, we did something a little different with this webinar. We went out and asked you all, what do you want to hear about? And we got a lot of great responses. The general message was everyone's interested in the sophisticated stuff. I think whether you have clients at the ultra high net worth level, if not, you aspire to have clients at that level, right? And understanding the type of planning. One particular strategy that we do a lot of here for this webinar will be useful, and folks want to hear about it. So Samantha is a practicing attorney. I'm not a practicing attorney, so I'm going to let her have most of the oxygen to walk you all through this strategy. And the strategy is basically being able to take a sort of a holding company and reduce the value of the client's estate before you transfer it out. We've only got so much we can transfer tax-free. We want to squeeze as much into that exemption as possible. We want to find points of leverage where we're not getting retail price, so to speak, for the assets that we're going to be transferring out of the state. And we want to do so in ways where we still have a lot of control over those assets that we've transferred, and even potentially in some cases being able to still benefit from those assets. And Samantha's going to walk through that strategy. Sort of what I'm going to focus on is everyone else. So, you may have clients that aren't in that ultra high net worth level of assets yet, but maybe they're approaching it. And I think there's often a view that, well, if the client doesn't have a taxable estate planning's easy, right? You go through, you answer some questions, you get the documents. And I think actually there is a lot of complexity with estate planning that can hide under the surface for those that don't have a federally taxable estate. The most common one we see is really asset protection into those next generations. It's, well, I want to leave my kids my property, but what does that mean? If that property then gets commingled with their marital property, we've now created a situation where their son or daughter-in-law might end up with a significant chunk of their life's work that they're passing down to their kids. You start talking to clients about that, and we rarely meet a client that doesn't want to add some protection to their plan, right, to make sure that that doesn't happen. You mean there are ways I can make sure my son or daughter-in-law has, or my son or daughter has everything they need, that their family's taken care of. But if there were to be a divorce situation, that property stays segregated and doesn't become a part of the divorce estate. And those are called lifetime protection trusts. They're our most popular type of planning. But they do add some complexity because now we're talking about basically a permanent trustee kind of regime. We're going to need some kind of committee to make sure there's flexibility in there and the ability to change out fiduciaries, or potentially even let a child become their own trustee, or maybe it's a co-trustee. We see this a lot where the child's working with a corporate trustee. And then at a certain age, they're able to become their own trustee. They need to learn how to kind of respect the trust as its own separate thing, so that courts and others that we want to respect that kind of separation do the same thing. Also, clients that are, you don't have to be at $30 million, of course, before you start doing federal estate and gift tax planning. In fact, the best time to do federal estate and gift tax planning is while the clients have appreciating assets that haven't realized a lot of that appreciation yet. So you got a business that's doubling year over year, worth 15 million right now. The best time to do that planning is when the business is still worth 15 million, getting that out of the estate, letting the client, continue to benefit from it, and exercise control over their business, but kind of stop that appreciation inside of their estate, let the rest of that happen outside of their estate. And Samantha's going to talk about that. So, it's a blurred line in terms of where complexity starts, and complexity can start well before the client gets to the so-called federal estate and gift tax exemption. And just to kind of step back a little bit and tell you about what we do here. So Hargrove Firm came from my father, Jamie Hargrove. He was the head of trust and estates in big law. And my last year of law school, he quit his job wanting to start an online law firm. The goal was to figure out how to take what he was doing for a small number of really high, ultra high net worth, these type of families, and scale that out to where a much larger swath of the client base can benefit from that. His practice has always been centered around financial advisors, wealth advisors. So we built our business around wealth advisors. We don't advertise to clients. Occasionally we'll see a client, we don't turn them away. That's found us somehow, but we exclusively work with wealth management firms. We integrate with the wealth management firm. We want to make it the lowest friction process for you to be able to make a referral, stay involved in the process, know what's going on in the process. You should never have to pull information out of us. You should always know where your client's at in the process, what needs to be done next, and so on. So we built a platform that supports the ability to deliver legal services at scale. But at the end of the day, with all the technology, it all exists to make those interactions with the real heroes in our process, which are the attorneys, people like Samantha that have been practicing for a decade or more, that know sophisticated planning, that know planning at both the state level, where we have specialists from every state that get involved depending on where the client's at, and then at the federal level, people like Samantha that know the more complicated planning strategies that are really, more federalized, looking at kind of national rules around there. I think the last point I want to make in just looking at the clients that aren't at that level yet, and kind of making the point that there is a lot of complexity still in those. State inheritance taxes or another one, Andrea, if you want to touch to the next state. Once you've said, well, is my client, are they going to hit the federal number? And remember, the question isn't, are they hitting the federal number now? It's, do they have appreciating assets that over some period of time are likely to hit that number? And if the answer is yes, then now's the time to start having those planning conversations, not when they hit the number. But let's say, it's a client with a few $1,000,000. The next question is, where do they live? If they live in New York, for example, which I think we're about to see on that slide right now, there's a little trick in the law there. So if it's $7 million you die with, you're fine. If it's 7.35 you die with, you're fine. If it's 5% over that, you're taxed on the full amount. So you don't just pay the incremental amount over the exemption that you're taxed. Once you hit 5% over it, the entire estate gets included and gets taxed. There are basic planning strategies we can use to plan around and really blunt the impact of that tax regime. But again, you're not going to know that if you're just looking at it like, oh, well, the client's got $5 or $6 million in assets. By the time they die, it's probably going to be $10 million in assets or more. This is pretty simple. We'll leave it to their kids. We'll have it go at 35 and 25 and 18 so the kids don't get it all at once. We've done our planning right. And I think these are things that a lawyer can help elicit during the process, and then provide solutions that they're not just creating documents for you, but they're taking responsibility for those solutions as well. So enough with my intro. Samantha has been with us. She was one of our early attorneys. And she has a lot of real experience practicing in this area. And I'm going to let her walk you through what's the most common sort of layered strategy that we use for ultra high net worth clients and those looking to do that type of planning.
Yeah, thank you, Alex. And Andrea, can you back it up just one slide? Perfect. So before we get into talking about this planning topic today, now's a great time to consider it overall because we're lucky to have very high federal estate and gift tax exemption levels. And this wasn't always the case, right? The exemptions used to not even be $1 million, which left many more people exposed. But now, while we have such high amounts, it's good to take advantage of them with lifetime gifts. Now, this timing matters more than actually trying to predict what Congress might do and when, because nobody really knows. Even though these exemptions are considered to be permanent right now, there was a time a couple years ago when they were slotted to be cut in half with a sundown provision at the end of 2024. So it's important to consider this type of planning if it is right for your clients now, while we still have the high exemptions to make use of. And the best candidates that are right for this type of planning, as Alex said, they have highly appreciating assets. Maybe they're exposed to estate taxes at a state level, or maybe they're approaching the federal threshold as well. But it's important when talking about gifting, you don't want to gift just for the sake of gifting. It needs to be the right asset. The client still needs to have sufficient liquidity outside of the gifted asset. There's also basis consequences to consider because you do lose step ups in basis. And overall, the client does need to be comfortable with this type of strategy. So since timing's so important here, the next question is what assets are actually ripe for this type of planning? How do we move them without giving up control for your client now before he or she is ready to give up control? And that brings us into family LLCs and intentionally defective grantor trusts. Can you go for the next slide? Thanks, Andrea. So the most important consideration for clients before we start this type of planning, or if we even start to touch on these concepts is, well, I do need to reduce my taxable estate, but I'm not ready to give up control of my business yet. My kids aren't ready. I'm still kicking. I want to keep the benefits here. I want to stay in control for a while longer. So that's the rub. The client wants to do this planning, but doesn't want to give up control yet. And when it comes to the type of assets we usually see this with, think family businesses. Maybe the client has a farm that's been in the family for generations, or a ranch, or other types of real estate. And the distinction here is that control doesn't have to go with the economic ownership and benefit of these assets. We can create an entity structure, which we'll go into today, the family limited liability company, that separates these two. They don't need to go together. And the ultimate goal, before we start this type of planning, it's important to know we're moving value and appreciation out of the client's taxable estate, but the client still gets to keep that control over the business if he or she's not ready to give over the keys to the kingdom to the kids just yet. But it's important to know this isn't a sham of a strategy. It's very real and it needs to be honored. We can't give assets away and still have the client treating them as if he or she personally owns them. We don't want to risk having the whole transaction collapse and then clawed back into the client's estate. So how do we actually separate that control from the economic value? This is where we get into the family LLC and the irrevocable trust solution. So, like I mentioned, ownership and economic benefit don't need to be kept together. And that's what makes this family LLC such a great planning vehicle in that it's the organizational platform. So this is where we're able to separate that control and economic ownership. And the irrevocable trust comes into play here because that's where we actually that's what we use as the wealth transfer vehicle. So these two work hand in hand nicely. And then we also have valuations that are very important that I'm going to go through a lot today because that's how we determine exactly how much of the client's gift tax exemption we're using in this overall transfer. So first, we set up the family LLC. And I'll start by saying if you already have an existing business, we can potentially make it work within your existing structure. Maybe the client has a single member entity, but it's 100% Class A voting interest. We can always recapitalize. Well, I should say always. I'll give you the lawyerly answer and say, maybe we might be able to recapitalize an existing business, but we can always form a new one to set up this planning structure. And it's important to note too, this business needs to have a legitimate purpose, such as the liability protection that comes with an LLC or business succession planning. We can't just set this business up for the purpose of doing this type of planning strategy. Second step is to separate the new or existing family LLC into voting and non-voting interests. So we do that within the operating agreement, which is kind of your blueprint for how the business functions. Is this a manager managed LLC? Is it member managed? What happens if a member passes away? What's our process for winding up or dissolving the business? So within that document, we can separate the classes of ownership. You might see, like I mentioned earlier, maybe just Class A voting 100% in an existing LLC. We can separate that Class A voting interest and also create the Class B non-voting interest, which is what we use to transfer this value out of the client's taxable estate. So once we have that non-voting interest parceled out, the specific irrevocable trust we'll talk about here is an intentionally defective grantor trust. And I know you guys know we love our acronyms, so I'm going to refer to this as an IDGT. And I thought it was funny the first time I heard it too. So for today's purposes, we're going with the IDGT. It's important to note that this interest is not transferred to the child individually. We use this trust vehicle because, like Alex mentioned before, this has that type of advanced protection built in for your kids, your clients' kids, and beyond. So this protects them from creditors, their divorce, and it lets you do some important generational planning. So in order to move these non-voting interests into that irrevocable trust, it can be structured as either a gift, which uses the client's gift tax exemption currently. And with that, it's important, I'll go through this too, it's important to rope the CPA in here because that does require filing a Form 709 gift tax return. But we're just disclosing that we're using part of the client's exemption. Most likely no taxes owed, so not really taking a hard look because the IRS isn't expecting any tax to come through. But that's an important component if we're structuring this as a gift. We can also structure this as a sale, where the client sells these non-voting interests into the IDGT and receives a promissory note back. This would be appropriate if the client wants to preserve their exemption instead. But it's also important to make sure the client has outside cash flow to actually pay down that promissory note that's going to be in play here. So there's a lot of different factors and there's different ways. We can also combine and do a part gift, part sale. So it's very fact specific and it depends on a lot of different circumstances that we can determine based on what's right for your clients. So important to note here, parents keep management and asset control, but now the trust holds the economic upside. So now any further appreciation that occurs on the non-voting interest that we put into the IDGT, all that growth is occurring outside of your client's taxable estate, which is one of the biggest upsides of this type of planning. And Andrew, you want to go to the next slide? Perfect. So to distinguish a little more about the voting versus the non-voting interests, when we think about the voting interests that your client or the parents can still retain, this deals with operational interests, right? They can select and remove managers if this is a manager-managed LLC. They can approve sales and financing, enter into leases if we're dealing with some residential or commercial real estate here, and admitting other members into the LLC. Now, the trust that holds the non-voting economic interest, which again, it's not meaningless. This does have substance to it. So the trust is able to participate in distribution, appreciation, so any liquidation rights. If there's a future sale of the business, proceeds need to be going into this trust. We can't just decide now we want to look the other way and not consider the trust when we have a big cash out coming from the sale of the business. So clients like this because, hey, they can still run the company. But again, if the business is sold, it belongs to the trust, the proceeds, not the client, him or herself. And the IRS respects this, but only as long as the formalities of the transfer are respected. We need the trust to be receiving distributions and not the client. And it can't be, we're using the property as we did before and nothing's changed, because we don't want the IRS to pull this property back into the grantor's estate because the grantors retain too much possession, use, control, or beneficial enjoyment. So the control stays easily, but we're getting rid of the growth here into the trust and outside of the taxable estate. So now we can get into valuation discounts a little more because this is a key part of this transfer. We're not just coming up with, I'm not the one who's determining these for instance, we have an illustration here on this slide, but that's not just something I came up with, and us attorneys can't just say we decide that this much, we get this much of a discount on these transferred assets. We're actually roping in and getting a qualified appraisal because it's important to substantiate this value. So you see here, the two biggest components that actually get us this discount are lack of control and lack of marketability of those non-voting interests. So when we say lack of control, this means those interests and the owners thereof can't direct investments. They don't have any management rights in the company. They can't force a sale. They can't replace managers. So they don't have much of anything in the way of control of the company. And when we say lack of marketability, there's not really a public market to purchase these interests because who would want to buy something that they can't control, they can't easily sell it? And this is very fact intensive too. So what might apply to one business doesn't necessarily apply to another. That's why it's so important to have that qualified appraiser involved. So when we look at the appraiser's conclusion here, like I said, I'm not the one who picks this discount. You can look at sometimes in the range of 20 to 30% of a valuation discount. And when we get that discounted number, that figure is what we're actually transferring out of the client's estate and reporting on the gift tax return. So you've used more of your exemption for less. The assets are out of the taxable estate, and we didn't have to disclose as much as they're really worth because they're valued less. And we have the numbers, we have the report to back that up. So what the appraiser actually takes a look at, they're going to look at the business governing documents. They're going to look at lack of control, lack of marketability, those being the two biggest factors. And then they'll give their overall qualified appraisal. And like I mentioned before, once we have this, it's important to rope the client's CPA in and file that gift tax return. So that starts the 3-year statute of limitations, where again, we're not saying that there's any tax owed, but we're reporting that we've used either part, if the client's single, part of their $15 million gift tax exemption, or if the client's married, part of that $30 million gift tax exemption. And you want to go to the next slide, Andrea? And now we're going to shift into talking about that IDGT, that good old irrevocable trust here. So again, it stands for intentionally defective grantor trust. And the defect comes in here because while the trust is respected for tax purposes, transfer tax, gift tax, the grantor, so your client, is still the one who pays the income tax. The trust itself is not paying the income tax. So within this vehicle, this is where we can build in the future creditor-predator protection for your kids, for generations beyond. We can restrict transfers of these assets. So this is a great multi-generational planning trust. But what's most effective about this is the income tax, because the client pays the income tax generated on all those assets in the trust. The trust is not paying that. So therefore, the trust assets get to appreciate further and further without being spent down incrementally on filing the trust's own tax returns. So the grantor, also by virtue of paying that additional income tax, is reducing his or her taxable estate even further. But with that being said, and with all that in mind, it's important to note that we need more liquidity outside of these transferred assets to make sure that the client's able to comfortably pay those income taxes. If we've shifted way too much out of the taxable estate too early, if there's not sufficient funds left behind, we don't want the client to feel squeezed and uncomfortable and struggling to make those income tax payments. And when it comes to reimbursements from the trust, we can't have mandatory reimbursements for the grantor because that's too much possession and control. We can include discretionary reimbursements, but they have to be carefully crafted there. So we still need sufficient liquidity to pay those taxes, but that's where the preference for this IDGT comes into play here as the vehicle. And perfect. So now when it comes to actually implementing this whole strategy, this isn't like, you sign your run-of-the-mill revocable trust. We have our nominal funding language in there, and now trust is created, good to go. No, to actually put this strategy into place, we need a lot of documentation here. So first, when we create that family LLC, we've got our operating agreement to establish voting, non-voting interest. We get our valuation report to say, here, we got a 20% discount on those non-voting shares. Now we've got the planning vehicle, that IDGT set up, and we assign those membership interests of the non-voting interest into that trust. So that might be assignment documents, maybe a purchase and sale agreement, if we're talking about a sale here. Security agreements, promissory notes. We want to make sure that the trust has formally accepted and received that asset, and updating any K1s, any member or manager consents that are needed from within the family LLC. And then if we're talking about a sale with a promissory note, the client needs to be making those payments on time. We need to make sure that the Schedule K1s are correct there. The operating agreement needs to be updated if we need to do any gift tax return filing. All these formalities matter a lot, because if we've just come up with this plan, but you can't see any of the steps actually on paper, we need all that to take place so that everybody knows, okay, great, we've done this right. We've got our desired goal here. And as the advisors, you all can help with your clients, and maybe you notice one of these rapidly appreciating assets. And outside of that, the client still has sufficient liquidity where you're thinking, oh, this planning might make sense. And we've got the right cash flow to make this a comfortable transaction for the client overall. And we've got a nice little diagram here to show you all how this works. So we start with the parents or your clients transferring their assets into that family LLC, or if we've recapitalized an existing LLC, there it is. And at that point, we split the LLC into the voting rights, which stay with the parents. So all the control stays on that left-hand side of the diagram. And on the right-hand side, that's where we have the non-voting interests sold or gifted into the IDGT to benefit kids and grandkids. And now when it comes to putting it all together here, so important to note, your client's not giving up control. We can do this now. It doesn't mean we're retiring or we're stepping away from the business. The kids get the long-term economic benefit, and we've got great estate tax reduction for your clients here. The appreciation's outside the estate, so these assets continue to grow. Maybe this is a beach house somewhere, beach houses are nice everywhere. I don't even know, somewhere. I'm in Florida, so maybe down in Miami. We've got a beach house that's growing, beyond anybody's wildest dreams. And now that all occurs outside of the taxable estate. And we get that asset protection benefit and the generational planning that your client probably already desires for their kids, for their grandkids, and even beyond. But it's important to note this planning doesn't get rid of income taxes. It's not an elimination strategy in that way, but it's important that the client, the grantor, is the one who pays the income tax and not the trust itself. So we're preserving even more of the trust's core assets. We can't guarantee that there would be a valuation discount either. Most likely, but again, it depends overall. It's very fact specific, and in working with the qualified appraiser, you'll be able to find out exactly what discount you can get for your clients when we do this type of planning. And let's see, we permit the grantor to retain every benefit. That doesn't happen either. We still have control over the business, but we're not getting distributions. We've transferred those assets into the trust. So now they're out of our control. We have control in some semblance in terms of the management of the business, but kids and grandkids, however we structure the beneficiaries of the IDGT, they're the ones who ultimately receive the economic benefit now. And then to shift a little bit into a similar desire here to keep control but remove appreciated assets here would be a QPRT. So First, before we touch on that, your ideal client here, like Alex mentioned before, we're looking at federal estate tax exposure. So maybe around 15 million, 30 million, but also state estate tax exposure can factor in here as well. The key piece is we have highly concentrated assets, whether it's real estate, a farm, a ranch, an existing business, or even an investment. It doesn't need to be a functioning business. There's a lot we can work with to do this strategy. We want continued management. There is sufficient liquidity outside of what we're transferring here so that the strategy is comfortable. We don't want to lock the clients into something and then they're feeling a bind because it's hard to pay the income taxes and we're struggling to maintain our lifestyle now. It should be carefully considered with all of your client's assets in mind. And the client has to be comfortable with the fact that this is an irrevocable transfer. So it's not something, this all sounds great now, but 5 years from now, I want to go back on this. I don't think I like this strategy anymore. Nope, it stands the way it is. So it's always important when we're talking about irrevocable trust planning to be aware of how permanent it is. And the asset composition really matters here. It's not just enough to have that 15 to $30 million wealth. Maybe your client has $30 million, but highly concentrated in retirement assets. Maybe not the best candidate here. So now to get into the QPRT, just as one variation of this strategy, where we've been talking about businesses and farms when it comes to utilizing the LLC, a QPRT deals with the same overall desired response and giving up some, keeping control, but also moving value out of the taxable estate. But this is a personal residence strategy. So your client, the grantor, still retains occupancy for a fixed term, but once the term's over, maybe it's 10 years, maybe it's 20 years, then the property transfers to the stated beneficiaries. And the client, important to, as much as we can control this, outlive the stated term, then would need to continue residing in the residence, but also paying rent at fair market value. So that can be something that's a little bit uncomfortable of, oh, now my children technically own my house and I have to pay them rent. So it's not a strategy that's for everybody, but if your client has, a vacation home, a beach home, highly appreciating, this might make sense to discuss here. So to sum it up, today's strategy, it's really about identifying those appreciating assets early. And while we have such high exemptions to make use of, we can separate that control from the economic benefit, transfer the economic interests into that trust to continue down for the next generation, but also reduce our estate tax exposure. So if you see a client that has rapidly appreciating assets of any kind, close to estate tax exposure or maybe at the state level, and if they have a long-term planning mindset, generational planning for kids and grandkids, we're happy to have you schedule an initial consultation if you want to bring the client in, or you as the advisors, you're welcome to schedule a quick one-off conversation with myself or another one of our staff attorneys to see, hey, we've got this asset. Here's what the picture looks like. Do you think this would be a good fit before we bring the clients in? So we're happy to meet with you about that. And
Does
now
that mean
we've got one of our advisors, Lynne Celia, who's going to discuss her planning experiences in using our platform for her clients.
Hi, Lynn. Are you with
Hello.
us? Great.
Yes, I'm here. I made it. And thank you both for having me today.
Thank you.
I've worked with Samantha with a few of my clients, and she is the real deal. And what can I say? Where do I begin? Well, first of all, I love the topic. And as an advisor, having been doing this for many decades, I mean, I'll be very, very candid, right? With the estate tax threshold so high, not a lot of advisors work with people with this much money, right? It'd be wonderful if you could poll all of the advisors on the call today to see, what's your average client AUM. But I will tell you more than not, this topic has come up a lot on my side of things in the past couple of months. We see estate planning thresholds coming down. There's no crystal ball, but if we're planning for our clients, whether you're an estate planning attorney or an advisor, the devil is in the details, and we have to always be forward looking. What happens if it changes? Do I want to be in a proactive mode or a reactive mode? Anyway, so I'll get back to my relationship with Hargrove, because I only want to take a few minutes, I think, here, but because I'm sure you might want some Q&A on this awesome subject. I even have some questions. But so I'm with Wealth Enhancement, and I joined Wealth Enhancement about 18 months ago. And that's how I met Hargrove. And I was intrigued because as an advisor, I am sure all of you on the call know that when you're dealing with an external estate planning firm or an external CPA, right, that the communication lags and the back and forth is not optimal. So when I learned that Wealth Enhancement had this relationship with Hargrove, and as I've onboarded more and more clients in my first 18 months, I've done about 100 million so far in the first couple of years. I'm delivering white glove service to my clients. And therefore, in my partners, I look for them to also deliver white glove service, right? So I rely heavily on my referrals to accountants and estate planning firms. Now, I'm fortunate that Wealth Enhancement actually has an internal tax team who are Wealth Enhancement employees, CPAs, etc. And it's like having a bat phone, you know? If I have any question, any call, anything, bam, I go straight to them. They're Wealth Enhancement employees, and I get my answers, and I deliver white glove service to my clients. They are client facing, so they deliver white glove service. Hargrove is its own entity, but I will say, and they didn't pay me to be here today to say this, they are truly partners in the sense that they deliver the same white glove client experience that I expect of anybody that I put in front of my client. They are, you know, you have to level the playing field. You have to assume that any estate planning attorney you go to that's reputable is going to do a good job, right? I do that with myself. Any advisor that my prospects are talking with are going to do a good job. So what makes me different? How do I add value? And it always comes down to the people, right? The skills, the people and the skills and the intelligence and the capability and the client experience. And now with them being virtual, they're always at my fingertips. So, and I think how I met Alex and got involved with them was I made the comment one day, and I don't know how they got a hold of it, but it wasn't to Hargrove. I said, unless my client was maybe to my peers, there's 600 advisors. And I said, if my client doesn't need an in-person experience, then I'm going straight to Hargrove, period. You know, we don't do a lot of idiots. How many idiots have you done? How many will you do? But the point is, you've got to get your clients to do the basic estate planning. And if you want it done really well with an awesome client experience, right, you can get it done here with this company. That's my experience with them. I've never even actually shown up on a continuing education event to give my 2 cents. But the fact that your father, Alex, had that idea to go from brick and mortar to virtual, but still retain that best in class expertise, only you make it virtual. That was brilliant. That was brilliant. You've been super successful at it. And if you're an advisor that's looking for incorporating, well, if you're a planner, estate planning needs to already be a part of your practice. And if it isn't, then you need to make it a part of your practice. And these guys are the ones that are going to do the basics all the way up to the uber sophisticated crit, crat, cruts, and idgits, and you name it. Matter of fact, I just met with a client, a very wealthy client, and this is perfect. So your topic today is spot on, and I'm going to be calling you right after we hang up. That's my 2 cents.
That is great. Thank you so much for that, Lynn. And yes, very early on, we had a decision point to make that's just was really fundamental to the business. Do we try to be the low cost provider? There's a lot of technology driven services out there, and it's been a race to the bottom with pricing on those things. Or do we charge a fee for our service, but we make sure we deliver white glove service with that. And I think they've seen, last year we piloted at-home execution. We had launched with a kind of mix of you go find your own person to do your will, and we'd execute everything else digitally for you. And when we sent the first client with that at-home team, I got a 3-paragraph review from that client just glowing about how great that experience was. And we said, whatever that cost, we're going to figure out how to deliver that, to every client that comes through. So everyone saw we adjusted our pricing a bit, and that's now included. Every client gets that. And I think that's how we've ended up with a business like this, is making that decision that we want to be the white glove service provider. Yes, because we use technology and because we're meeting on Zoom, not in an office, on Park Avenue in New York, we're able to offer much more value than what you're going to get at that big law firm in Manhattan that does have all that real estate and overhead they've got to pay for. Maybe in a smaller market in the middle of Kentucky, we're just competitive. But, our goal is not to be the low cost provider. We're there to be the white glove service, to pick up the baton from you all and provide service at a level you expect from your client. Samantha, I think that was an awesome walk through what is a complicated strategy. And I can't think of any strategy that more spells out why it's best for an advisor and an attorney to be working together with a client on this type of planning. I can't imagine going through that kind of planning just as the lawyer. Kind of the mechanics of how to do all of this, but you heard there's selection of assets, and is this strategy right? If the client's doing this, and what's their goal in 10 years? And, that's way too much for a lawyer to unpack in an engagement like this. So you need somebody like Lynn that's been thinking about those things with this client probably for a long time, that can work with that attorney who can say, oh yeah, based on what you're talking about, this is exactly what you need, and take responsibility for that work product. But the two don't work very well, I think, on these type of engagements when one of those pieces is missing.
I couldn't agree more, Alex. I've always said, right, you have, let's say, a client really wants that in-person experience, and okay, and you maybe they have somebody, or you give them a referral. But I am not integral to that relationship. And that is the difference. I have no control. I make a phone call. I am not a priority for that attorney to necessarily call me back, right? And well, I'll back up even and say that if you leave it to the client to get their estate planning done with that law firm up the street, 9 out of 10 don't get it done. And there you are, you're the advisor, you have a client, and now I can go on and on about the horror stories of clients that don't have their estate planning documents done. So first, you've got to get them done, period, right? And that is what the virtual process allows us to do. I say, you know what, to my prospective client who has no estate plan, I say, you know what, I can get them done for you. We can get them done with Hargrove. I say within 3 months, you're done. I had a client going in for massive surgery, no documents, and we signed them and she went and had the surgery. Peace of mind.
I think something that's great about our business model is we're building long-term relationships here. We have institutional backing behind our managed service organization, which provides a level of scale and sort of leverage that you don't get in a traditional law firm. We have the ability to say, hey, we're gonna accelerate this, or we're gonna wipe a fee off because the client's not happy for some reason. You know, even when the clients aren't right, the clients are sometimes not going to be happy with something. And we're going to make sure that's right. You know, we'll eat the planning fees. We'll have the extra meetings. We'll send the notary team back out again because the client forgot about something. They forgot to order a deed from their trust. Because the kind of relationships and the kind of business we're building are ones where over the next 10 years, you know, we're valuing what our relationship is going to look like with you, not what we're going to make on that next referral. That you're going to make. I'll kind of wrap this up a little bit just on the higher end topic. I think Lynne is right. I think we're kind of in a place where the pressures, the pendulum seems to be potentially swinging in a different direction when it comes to these lofty exemptions. When you decide you want to start taxing more, the estate tax is always a great place for folks to start that conversation. Now is always a great time to start talking about those things with clients, particularly clients that have assets that are appreciating. What we've heard from the market, we thought very early on, oh, most of the business is going to be in the non-taxable states, $5 to $20 million. You know, folks in the super rich folks, they've got that all dialed in. What we've heard from the markets, that's not the case. We've heard from internal planning teams at big firms like WEG that the process, you know, they're doing a lot of the thinking for these clients internally. A lot of firms like probably yours have great attorneys. I know in particular at WEG have fantastic attorneys in-house that are doing some of this thinking for clients and suggesting strategies. But then they've got to go out to 1,000 different providers across 50 different states and figure out how to get that work drafted, how to get somebody that's going to draft the documents and take responsibility, ultimately kind of sign off on the planning that's being recommended for the client. And while it's not really a price game at that level, it's a predictability and turnaround time and how quickly you can get engaged with somebody once they're ready to move. You know, we interviewed attorney in Big Law the other day, and he says, you know, it's a 2-month wait process to get on my calendar. You might get a little on the earlier end of that if I really like you. And then it's probably 3 to 4 months to get the work drafted. And that's probably a conservative estimate coming out of what some of these practices look like. They're typically run as lifestyle businesses, the ones that really know what they're doing, that can practice at this level. They don't have availability. And the ones that do have availability really don't have the experience needed to do this type of complex planning, and really even to do the type of complex planning we talked about at the beginning with folks of lesser means, folks that do have some meaningful assets and need to make sure those are protected in the next generation, and they understand how the structures work and what that means to have those structures in place. So Lynne, I can't thank you enough for getting on here and sharing your story. You and everyone at Wealth Enhancement Group has just been a fantastic partner. And Samantha, that was such a great overview of a simple topic, you know, the ways you can sort of take assets and impose another level of valuation over top of those assets where you're creating this structure where a business purpose can be as simple as we need to manage assets for our family. We need to worry about succession planning. You know, those are reasons to go start one of these structures and look at potentially getting valuation discounts on the assets that you're trying to take out. And it's a complex topic, and you made it simple. So thank you.
You're welcome.
All right. And if anybody is interested in working with us that hasn't been working with us, one of the leaders on our relationship team there, Mo, is up on the screen. His email address, actually, if you saw the press release this morning, we are all Hargrove now. So even those of us with a NetLaw email address, it'll still go to Mo. Just email Mo at that email address. But the brand going forward for us is going to be Hargrove. The folks that were working at Net Law supporting Hargrove, we're all still there, but we're going by Hargrove MSO now, the Managed Service Organization, which is sort of a name for a structure that can support the law firm and is kind of necessary given the regulations around this space. Or reach out to me, Alex at hargrovemso.com. All of our contact information is on our website. What we'll do is just walk you through the process. What does it look like to refer my client? What's step one? What's my client going to see when we go through this? Everybody's scared to kind of make that first referral. So we're going to de-risk that process for you. We're going to offer your client a free initial consultation as well. So you're not sticking your neck out very far to work with this. You're just getting another opinion for the client. And again, we can show you what all that looks like. Thanks to everyone. Awesome turnout today. Appreciate everybody showing up.